Welcome to Stocks Review. Click the subscribe button for more up-to-date short stocks and portfolio review. This portfolio review is only for entertainment purposes and not financial advice. Today we are going to start a new series. What do these four people have in common? They are all famous and some of the richest billionaires. They are all business owners or founders of the companies which make them rich. In short, the majority of their wealth comes from holding most of their net worth in growth stocks for a long time. Bill Gates is the founder of Microsoft and owns the majority of its shares before selling off gradually and diversifying into other stocks. Microsoft has been growing its business and keeps Bill Gates being one of the richest people in the world. Had Bill Gates not diversified into defensive stocks, he would be much richer now. But diversifying may still be a clever decision for reducing portfolio risk. The same story goes to founder of Amazon Jeff Bezos. The growth and success of Amazon has made him a fortune. Elon Musk is a little different. He was rich before getting involved in Tesla. He had received $100 million after selling his stake in PayPal. He was initially an investor in Tesla, and later became the chairman of Tesla after becoming the largest shareholder. The initial founders of Tesla are nowhere near the wealth status of Elon Musk now due to selling off Tesla shares early and not holding it for long term. But wait a minute, isn't Warren Buffett a value investor, and became rich due to buying cheap and valuable companies and selling them at a higher price? That is only partially true. Most of Buffett's wealth comes from the companies that had grown by time: Geico, American Express, Moody's, Apple, and even Coca-Cola. Coca-Cola was a growth stock when Buffett started buying its shares. Berkshire Hathaway is also a growing company. Although growing much slower now, Berkshire Hathaway is still growing its revenue at a steady pace. So we come to a conclusion. All these billionaires became rich because they hold good growth stocks long term. You don't have to fully own a company, start a business, or have all your net worth tied to one company to become rich. In fact, if you have equal portions of your wealth invested in these four companies years ago, you would still be very well off now. However, a portfolio consisting of only these four stocks may not provide the best growth opportunity in the future and is relatively concentrated. We don't need to have the talent to run a business or create a startup to make money from holding stocks. We can construct a diversified portfolio consisting of large and reliable companies with pricing power and moat to achieve our financial goals. Therefore, I am constructing a portfolio of 25 growth stocks with a 10-year forecast revenue compound annual growth rate of at least 10%, and with a backtracking record in the last 10 years also having a revenue compound annual growth rate of at least 10%. I will pick the top 25 market cap companies, as market cap often reflects pricing power, liquidity, and lower failure rate. Companies that are in obviously authoritarian states are excluded for reducing regulation risk. And profitable and highly in debt companies were also excluded to reduce bankruptcy risk. This is the full list of 25 stocks as of April 9, 2022. I will read the full list of the 25 stocks at the end of this video for pure audio viewers. All portions will be roughly equal in size to limit concentration risk. The total value, total earnings of all shares, and total trailing 12-month dividend will be recorded and regularly updated in the coming episodes. The true underlying value and fundamentals of this portfolio over time will probably best be reflected by the total earnings of all shares, whereas the total paper value will reflect the actual performance of the portfolio and market volatility. Now, let's backtrack the portfolio to give ourselves some confidence. The one-year performance backtracking slightly lags the SPY, however, still remains afloat. The 3-year performance backtracking is much better and delivers a substantial amount of return compared to SPY. The 5-year performance backtracking is even better and delivers a return over 10x. We will track these numbers as metrics to measure the overall performance of this 25 growth stock portfolio. I'll just call this portfolio 25G. You can have your own version of this portfolio and play around with some ideas to add or remove some stocks. I will update this portfolio weekly and track its performance. We will review the stocks in this portfolio in the near future. Now that's all for today's 25G portfolio review. Click the subscribe button for more portfolio updates. If you like our content, leave us a comment and click the like button to give us some support. We hope to see you next time. The full 25 stocks sorted by market cap here. You can pause the video to write it down. Alphabet GOOGL, Amazon AMZN, Tesla TSLA, Nvidia NVDA, Taiwan Semiconductor Manufacturing Company TSM, ASML Holding ASML, Salesforce CRM, Netflix NFLX, Intuitive Surgical INTU, HDFC Bank HDB, ServiceNow NOW, Mercado Libre MELI, Illumina ILMN, Fortinet FTNT, Lululemon LULU, Monster Beverage MNST, Align Technology ALGN, Viva Systems VEEV, Enphase Energy ENPH, Genmab GMAB, Icon Public ICLR, Paycom Software PAYC, Generac Holdings GNRC, EPAM Systems EPAM, Signature Bank SPNY.